Good morning. It's great to be with you again. The market is in a golden period and it continues to deliver. Fortunately, our overweight continues to work, but valuations have risen from exuberant to irrationally exuberant. It's all about greed. There's no fear whatsoever. We're definitely in a bubble. The problem with bubbles is you don't know how much further they can grow. So there's a lot to look at today, but before we do, we'll look at the markets in September. And September was all about gold. You can see that gold in rand terms up 9.4% for the month. Now, historically, on average, and it's just what it is, an average, September is the worst performing month of the year from an equity perspective. But we had an incredible month of September this year, driven primarily by gold. Gold up 9.4%, drove South African equities up 6.6%. China also doing very nicely, up 5.1% on the back of Chinese tech shares. Alibaba and Baidu up nearly 50%, 50% for the month of September. So just everything is rallying. Emerging markets are rallying beautifully. South Africa is rallying. Gold is rallying. It's all quite incredible how strong the market has been. But the rally in gold has done something quite strange to our market. Gold hit $4,000 an ounce. It's up. It's had its best year-to-date performance since 1979. It really is just incredible. And it's completely changed the whole composition of the South African Stock Exchange. So if you go back, let's go back 2 decades, back to 2008. Just before the World Cup, it was all about the construction boom. China was booming. Everyone was using iron ore and steel and coal to grow their economies. And the biggest stocks in our market back then, accounting for more than a quarter of the market, were Anglo-American and Billiton, just because they were the base metals, industrial metals. Fast forward 6-7 years to 2016, the biggest stock in the South African Stock Exchange was South African Breweries, SAB. That was just before it was taken out by Anheuser-Busch. And that was also close on 25% of our stock market. And that gave our stock market a very defensive feel compared to 2008, when there was obviously a very volatile feel as a result of that commodity exposure. Then fast forward another 6-7 years, 2021, in the height of COVID, and suddenly Naspers and Process were nearly a quarter. In fact, I think they were over a quarter of our stock market. And now we've got precious metals, gold and platinum, making up 27% of the top 40 in South Africa. Just incredible how our market has changed over time. But right now, if you assume that precious metals, particularly gold, are defensive, well, then our market is incredibly defensive. The strange thing is gold doesn't seem to be acting in the defensive way that it used to. And I'm going to be talking a lot about that when I get to the opening slide for today's markets and economics. Anyway, we've had phenomenal resource returns this year. The Resi 20 is up 120% year to date, and that's driven our stock market up nearly 30%, in fact, over 30% year to date. So fantastic returns in our very much golden market. So we definitely are in a golden era for South African equities at the moment. And that's reflected pretty much in the fund returns. Over 1 month, we've got the ITRIX MSCI Emerging Markets 50 ETF up 9%. And that's on the back of the very strong technology performance in China. As I said, Alibaba and Baidu up more than 50% or nearly 50%. And Chinese technology stocks are catching up rapidly to US technology stocks as the AI field just broadens from being purely focused on the US to all the other beneficiaries of AI, and in particular, the semiconductor chips that are used to drive AI. So we have seen a very strong catch-up of Chinese tech stocks to FANG and the US Magnificent Seven. But over 12 months, you can see that the FANG stocks are still number 1 and number 2. So despite the catch-up, FANG still leading. But over the 1 month, China up 6% and the top 40 up 7% as a result of gold and Chinese technology. And then South African bonds doing very nicely for the month because the strong rally in gold has driven our currency stronger, and that's helped our bond market recover further as well. Although things aren't looking as rosy as we would like when it comes to South African bonds, but I'll talk about that more in the South African section. Back to the 12-month view, South African top 40 there as well, in third and fourth place, just behind FANG, and in fifth place in emerging markets. So it's very much the world has been driven by either technology, and that's technology globally, in the US, the FANG stocks, in China, in Taiwan, in Korea, and then gold. Gold seems to be driving the rest of the world, and in particular, driving South Africa quite strongly. So let's have a look at what's driving gold, because it really is fascinating.
That are going to be very affected, and the Democrats, they're going to be Democrats. As you know, no country can afford to pay for illegal immigration, healthcare for everybody that comes into the country. That's what they're insisting. And obviously have an obligation to not accept that. That would affect everybody that are going to be very affected. And the Democrats, they're going to be Democrats.
So the US government is shut down. So apparently is a good wall to all men that no longer exists. And Trump's approval rating is also down. In fact, it's lower at the moment in his term than any previous government since Bush. So things may not be looking up for Trump, but it's still a long term until the midterm elections, which are only in November next year. So for now, Trump is safe and his policies rule supreme. So when it comes to the shutdown, it's very interesting to see what happened the last time the government was shut down. So the last shutdown was also under Trump. It happened in December 2018 to January 2019, lasted 35 days, and it was the longest shutdown in US history. So this shutdown could last quite a while. The Congressional Budget Office, they estimate that the last shutdown cost the US $11 billion in output. And this time around, they estimate that there are 750,000 workers that will be furloughed. And that includes US troops who will not be paid, scientific research which has been suspended, and very important for markets, economic releases will be suspended. And that's very important for the Fed because they have said numerous times that they are data dependent. And it's very difficult for the Fed to be data dependent when there is no data. Looking at the markets, the best performing asset class during the last shutdown was gold. So it's no surprise that gold did so well over the month of September, as everyone was concerned about the shutdown, and as we got closer and closer and closer. Gold rallied into the shutdown. Once the shutdown happened, gold rallied further in 2018, and then in 2019, in January, when the shutdown ended, gold continued to rally. So very much a beneficiary through all three periods. Other asset classes were actually quite different. In the previous shutdown, the dollar weakened, US bond yields fell, and the US stock market fell as well, all into the concerns of the shutdown. And then on the day that the shutdown happened, everything rallied and continued to rally during the shutdown. And then once the shutdown was over, they stabilized. So we're seeing quite a different story now with the US markets rallying into the shutdown and then during the shutdown. So no concerns about the economic impacts of the shutdown. And I suppose that comes down to where we are in this current cycle, with the market believing that the Fed will save them. But we're going to also talk a lot about that because some of the market's beliefs about how many rate cuts are going to happen and how strong the Fed put is going to be, I think, are a little bit also irrationally exuberant. But before we get to the Fed, let's look at gold. So gold has always been seen as a defensive hedge. Why? Well, because it's not correlated to anything else. It's not correlated to inflation. It's not correlated to the dollar. It's not correlated to real bond yields. But things are changing. So while gold used to rally when the dollar was weak, that's not happening. In fact, since 2018, the dollar has strengthened and gold has also strengthened. Looking at inflation, gold used to rally with inflation, but more recently we've seen inflation coming down and gold continued to rally. Likewise, with real bond yields have been relatively steady, but gold has rallied incredibly strongly over the last many years. Geopolitics is the one that people say, okay, fine, well, gold's not linked to inflation anymore. It's not linked to bond yields. It's not linked to the dollar, but it's all about uncertainty and fear. And the geopolitical risks that the world is facing, that's what's been driving gold. But that also seems rather odd because economic and overall uncertainty levels peaked in April this year with Liberation Day, and gold has rallied since April, whereas those uncertainty levels have come down. So it's not inflation that's driving gold, it's not the dollar, it's not real bond yields, it's not even geopolitics. The one that I normally look at is gold to money supply, just saying that money supply is, or excess money supply is driving gold. That's also, that ratio has reached levels that historically have led to gold falling quite dramatically. The other thing that over the very long term should drive gold is mining costs. Because if the gold price is excessively high relative to mining costs, like it is now, if you look at the cost, you can see the gold price, this chart's a few days old and gold's already at $4,000 compared to 3,600, which is shown in this chart. That's how quickly things are moving. But the gold price is double mining costs, which means that over time, not only will secondary supply come online as recycling takes place, but gold mines will also increase their depth and the complexity at which they can harvest that gold because it's suddenly worth it. Gold reserves are obviously finite in the world, but what mines can get out is a set level, but that supply is dependent on the gold price. And as gold price rises, so that mining supply gets larger and larger and larger as it becomes economic to get access to that gold. So we will see more supply come online eventually, but that's a very long-term movement. So if gold's not acting like its historic drivers, what is driving gold? Well, I think the big one that we all know about, and I've spoken about, is central banks, particularly the BRICS and Gulf cooperation countries, which have been buying gold quite aggressively since the freezing of Russia's dollar reserves after Russia invaded the Ukraine. What is interesting is that those central banks only hold about 7% of their FX reserves in gold compared to the global average. And I was actually quite surprised. I had to look up this number 3 times, but the global average for reserves of central banks is 25% in gold. I didn't actually realize it was that high, but it's 25% of FX reserves are in gold. But 7% of those, the BRICS and GCC only have 7%. They are behind, and that means they'll probably likely continue to buy even at these excessive levels. But that's been going on for like 3 years. In the short term, what's been driving gold has been global investors concerned about the debasement trade, or the dollar debasement trade. And that talks about Fed independence or Fed credibility. And it's all about how independent is the Fed, how much political pressure can the Fed withstand when it comes to raising rates when there's inflation, or cutting rates when there's no inflation or employment's weak, and to what extent can you no longer trust having your money in dollars? And that's really what it comes down to: trust, credibility, independence of the Fed. If you can't trust the US dollar, well, then you're going to buy gold, because that's something that you can trust. There's only so much gold out there. I don't see any catalyst to turn this around. I don't see what's going to stop emerging market central banks and all central banks from buying gold. I don't see what's going to stop retail investors from buying gold. I don't see what's going to change Trump's policies. So the momentum that is behind gold, I think, is going to continue, but it's at scary levels. I mean, fundamentally, it's more than double its mining cost. We remain overweight South African equities because South African equities really now are precious metals. 27% of South African equities are precious metals, gold and platinum counters, which are a leveraged play on the gold and platinum price. So we are keeping our position long this momentum, but it is getting very scary, and we have tightened our stop losses. But we're staying long because we don't know what's going to change the view. But some of the things that could possibly change the view, well, a strong dollar should change this view. If there's enhanced credibility of the Fed, so if the Fed starts to raise the dot plots or cut rates fewer than the market is expecting, well, that could restore the market's faith in the Fed and reduce the concerns about political pressure. And if the dollar strengthens because of that credibility, well, then the gold price could come off, and it could come off very sharply and very quickly, and then everything that's linked to it could come off, as well as Bitcoin. So right now, certainly, I think any real asset that's benefiting from the debasement trade, whether it's gold, platinum, Bitcoin, even equities, they're all rallying because of this concern that the dollar can't be trusted. If trust is regained, well, then those things could turn quite dramatically. So it's either the Fed starts to act more independently, or possibly it's as the US debt levels come down, and then there's not as much pressure for the Fed to start have to for the independence of that Fed. And right now we're seeing tariff revenues on an annualized basis sitting at $375 billion. Compared to the amount of debt the US has, I know it's almost insignificant, but it's definitely a step in the right direction, and that debt can stop rising, or at least start to fall slightly, which might again bring some credibility back to the US. I'll talk to France later, but France is now onto their fourth prime minister, all because they are fighting over the debt to GDP levels, with big concerns that France has too much debt. What is the debt to GDP in France? 5.7%. Where is it in the US? 9%. Where is it sitting in China? 12%. So I mean, you can put that into context. There's a lot of debt in the US, and it's part of the reason why people are concerned about the dollar and debasement, because we're going through 4 prime ministers at almost half the debt levels. And, when we had Lettuce Liz, she survived less than a month because of the concerns that UK debt to GDP levels would increase. And they were nowhere near where the US is sitting or China is sitting. But both the US and China get away with it because they have their critical mass, which just means that they're too large to fail up to a point, obviously. So very, very interesting things happening in the world, very interesting drivers of the world. This lack of trust driving these real assets, and equities being a beneficiary of it, pension funds being a beneficiary of it. It's great to see such strong returns in all asset classes, particularly emerging markets, and we are avoiding emerging markets. But things are also getting pretty stretched from a valuation perspective. So let's look at the Fed, because this is all about the Fed credibility, and the Fed didn't do anything to help their credibility.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening? Or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually, the projections for growth this year and next actually picked up just a little bit, and inflation and unemployment didn't really move one. So
I'm not going to repeat it, because both Jeremy Powell and the journalist hit the nail on the head with the fact that the Fed cut rates, lowered the number of cuts, well, increased the number of cuts for next year, lowered the forecast rate, all while forecasting higher growth, higher inflation, and lower unemployment. And according to Bloomberg analysis, if you put that all into a model, that means the Fed is no longer actually targeting their 2% inflation target. The implicit target is now 2.8%. And that leads to further lowering of the credibility or the independence of the Fed, because why are they targeting 2.8% inflation instead of 2%? Now, yes, the Fed has a dual mandate. They have to worry about employment as well as inflation. In fact, there's a third mandate, which was raised by Moran this month, talking about stable long-term yields. And that is actually a very interesting point. So there is some justification for how Powell acted, and he could point to the very low employment numbers that happened in September and August as to why he cut. But still, it looks like the cut wasn't really warranted, and that's what has caused, I think, gold to rally as well in September. It wasn't just the US shutdown, but it was the fact that the Fed was quite dovish in its stance in terms of lowering the dot plot for next year and cutting this year, despite upgrading all the forecasts. And the US really is in a relatively robust position. Yes, employment is falling, but when you look at the data, the data we had until the US shut down, things are looking okay. Growth is steady. We're seeing lower interest rates, lower oil price, a weaker dollar, all of which are very stimulative for the US economy. Earnings are positive. Retail sales are strong. We've got deregulation in energy and in banking on the way. The fiscal stimulus from the One Big Beautiful Bill is on the way. And if you look at the ISM Services New Orders Index, which is a forward-looking indicator for how well businesses are doing in terms of new orders, it was the highest level in a year. So things are definitely recovering. Not only is growth recovering, but inflation is not going away. The ISM Services Prices Paid Index stayed above 69, which is its highest level in 3 years. And it mentioned tariff inflation 14 times, which is the highest number of times it's been mentioned in history. So tariff inflation is on the way. Not only that, but August inflation saw food prices hit the highest level since January 2023. And that's very important because the US consumer, they feel inflation the most through food prices. So when their eggs and their avos and their coffee suddenly cost a lot more, well then inflation hits home very quickly to this US consumer. And that's one of the reasons why Trump's disapproval rating is so low at the moment, is because those inflation numbers are feeding through to the consumer, even if the headline numbers are being hidden by other things like household rental, shelter inflation, which is falling, or other lagged effects. But inflation is there. Not only that, but inflation is likely to pick up quite quickly towards the end of the year as tariffs double, close to 19%, which is the estimate for the end of the year, and as we see more pass-through inflation from corporates. Now, focusing on the final point about the US being quite robust is employment, and this brings me to the chart on the right. So yes, Powell was allowed to cut rates because the labor demand, number of people hired, that's the blue line in the top panel, is slowing down. In fact, there was only a couple of thousand people that were hired on a rolling three-month basis. 22,000 people were hired on a rolling 3-month basis in August. Yes, that's soft, but labor supply is also soft. That's the green line. And the combination, if demand's dropping while supply is dropping, well, then your overall unemployment rate, which is the one over the other, ticked up only 0.1%, from 4.2 to 4.3%. So there's not much of an increase in the unemployment rate. And why? Well, labor supply is falling for a couple of reasons. AI adoption is one potential. There's also a lower participation rate, particularly by people who are retired. Aging populations is a big change. But the largest move is the deportation of undocumented workers. And we are unlikely to have seen the full effect of that feed through yet. So we're probably going to see an even further reduction in labor supply. In fact, Alpine Macro reckon that the new equilibrium rate for hiring is close to zero. That labor supply is not growing, so that labor demand as a result doesn't have to grow, which means the labor force isn't growing. Now that brings us very much to something that Japan started 20 years ago, Europe started a decade ago, China started 5 years ago, and that's when you get to a point where GDP growth, which is the sum of your labor supply growth, number of people working, and productivity, but GDP growth suddenly becomes purely focused on productivity because there's no more labor supply growth. And that then leads to lower overall growth. Fortunately, US productivity is the highest in the world, and it's likely to continue to be like that, at least in the short term, which will continue to drive at least a decent amount of growth in the US. But overall, it is quite important to show that labor demand in itself wasn't necessarily a strong enough reason to cut rates. Sure, maybe you could have cut rates this year as you did as risk management, but to lower the rate cuts for next year, I think that was certainly leads to an implicit inflation target of 2.8%. So understandable why gold is rallying, understandable why there's concern about the independence or the credibility of the Fed, because there certainly seems to be some political pressure in the forecast dot plot relative to the economic fundamentals. So we do stay neutral, the US, relative to other developed markets, so neutral to the US relative to Japan and Europe, while we are underweight developed markets as a whole relative to EMs, which continue to be driven by a strong China and strong technology spend, AI spend around the rest of the world. So let me move on to that.
Only when all countries, big or small, are treated as equals and true multilateralism is practiced, can the rights and interests of all parties be better protected. At present, the world has entered a new period of turbulence and transformation. unilateralism and Cold War mentality are resurfacing.
Certainly, that is the case. Things are definitely heating up from a geopolitical standpoint. But Xi Jinping seems to be playing both sides incredibly well. China has the negotiating power to do that, and that's exactly what he's doing. So Xi Jinping is pushing for a bipolar world by trying to buddy up with India and Russia and Korea. At the same time, he's talking to Trump and trying to negotiate things with Trump. So playing both sides, but for the moment doing it quite successfully, certainly more successfully than South Africa is, but then he has a bit more negotiating power than South Africa. So we saw President Xi Jinping host a two-day summit where he called on regional powers, including Russia, North Korea, and India, and there's some beautiful photo shots of them all together, to join together to leverage the East against the West. So pointing to that bipolar world of East versus West, and particularly East versus the US. At the same time, Xi Jinping and President Trump had apparently a good progress on their telephonic agreement on trade and fentanyl and the conflict between Russia and Ukraine and a TikTok deal. We still don't have the details, but it looks like that is going to move forward, with Oracle being one of the US companies that is going to buy a 50% stake in TikTok. They managed to avoid some of the sticky points, which I think are far more complex. The one being the US's stance on China. It was only after the call that Xi Jinping and China went to the US and said that they want the US to have a tougher stance on China, on Taiwan. The US hasn't responded on that, but that's definitely going to be quite an interesting talking point. And China also didn't push too far on unilateral trade restrictions, but that's something that is also going to come up continually in that debate. So for the moment, China doing quite well. We also saw China announce another fiscal stimulus last week, another 0.5% of GDP in terms of fiscal stimulus. That raises China's broad deficit to about 12.5%. I mean, that's just incredible, 12.5%, whereas France is on its fourth prime minister because they're sitting at 5.7% debt to GDP. The US on 9%. So the world is just flat out. Governments are spending for broke. And again, not surprising that gold is rallying so hard. But at some point, the governments need to start to rein that spending in. And that's exactly why the US is shut down right now, because they've run out of money. So we'll see what happens there. But interesting times when it comes to politics. Emerging markets, as I said, we are overweight emerging markets. They're doing phenomenally well. They had an incredible month on the back of commodities and China and Chinese tech. But also Taiwan's exposure to AI and South Korea's exposure to AI and chip manufacturing all pushed up EMs during the month. But that's pushed up the EM positioning to quite stretched levels. So not only is gold looking really, really stretched, but if you look at the chart on the right, you can see there that emerging market leveraged funds are the longest they've been in terms of their exposure to EMs in quite some time, more than double the 5-year average. So definitely emerging markets is a consensus play. Gold is a consensus play. Those plays continues to work, but they are looking pretty stretched. And as a result, we're keeping our overweight position. But just like with South African equities, we've tightened our stop loss on emerging market equities because things are looking pretty stretched. When they're this stretched, if something does happen to cause an unwind, it can unwind very, very quickly. Okay, let's look at South Africa.
We anticipate that headline inflation will rise over the next few months, peaking at around 4%. Our forecast now incorporates higher electricity price inflation of nearly 8% rather than 6%, given the recent pricing correction by NERSA. This is a reminder of the serious dysfunction in administered prices, which undermines purchasing power and weakens growth. The solution to this crisis is not a higher level of inflation, but rather sector-specific reforms to improve efficiency.
Couldn't have said it better myself. We need reforms. We don't need higher electricity prices. And you can see there our Reserve Bank governor getting quite upset because, as you're aware, the SARB is trying to lower the inflation target from the current 3% or 6% band to either just 3% or a lower band of 2% to 5%. But they've been blown out of the water by NERSA and Eskom, who have now said that for the next 3 years, electricity prices are going to go up 8 to 9%. Now, how do you target 3% inflation when your administered prices are going up 9%? Well, you just can't. So the governor is hitting hard back at the overall government, saying that there is serious dysfunction in administered prices, and he can't do his job while the rest of the government is not doing theirs. And that's fair play. It's spot on. We do need reforms. And we remain overweight South African equities and South African bonds, but not because of what South Africa is doing, but despite what South Africa is doing, mostly because we're overweight emerging markets and because of the fact that 27% of our stock market is now gold and platinum exposure. But when you look at SA Inc. itself, financials are up year to date 5% compared to resources 120%. That disparity just shows that SA Inc. isn't growing. And we can't grow when we're not competitive. And we can't be competitive when we're dealing with failing infrastructure. So one of the interesting data points was the CEO of Agbiz, and he noted that it's cheaper to import soybeans to Cape Town from Argentina than it is to get it from inland. And that just talks to the serious dysfunction in our rail system. The chart on the right from C-Track shows that freight volumes continue to fall. They peaked in 2022 and they have fallen year to date in 2025. So no reversal in those freight volumes from Transnet. Yes, Transnet has announced that they are lining up public-private partnerships, PPP, but that's only expected to begin at the earliest late 2026. So more than a year away, but more than likely early 2027, maybe 18 months away. So it's a long time before we see any recovery from that, which means it still becomes cheaper to import from Argentina than it does to rail things or bring things from inland. Likewise, we had the DG of the Department of Water and Sanitation who said that municipal debt owed to water boards has tripled from 2018 to 2025, reaching 25 billion rand. Now, how can you expect SOEs to fix themselves if they're not recovering the money that's owed to them from municipalities? So it becomes this supply chain effect. If we've got to fix municipalities before we can fix the SOEs, and there's just a lot that needs to be fixed before things can recover. And that's why our growth is sitting at 1%. And that's why we're stuck in this high levels of debt, because you can't get out of our debt trap without growing, and we can't grow without decent support from our SOEs. President Ramaphosa has acknowledged the challenges facing public services, including a skills gap, including outdated systems and processes and corruption. So we all know the issues. Of course, we've known these issues since Cyril came in during 2017, and there's been very, very slow pace of fixing anything. That said, BLSA has brought out a tracker where they are tracking reforms. And reform momentum, yes, off a very low base, is now at the highest level in a year. So things are starting to gain traction, but it's still going to be a while before we start to see the fruits of that. Not for the least of reasons, but we still have South African tariffs. So while the rest of our neighbors in Africa saw their liberation tariffs slashed dramatically by 80%, 60%, 50%, we're still sitting at our original tariffs of 30%. And that could reduce our GDP by up to 0.3%. Now, that sounds like nothing, and it's nothing for China or the US, but when your growth is only sitting at 1%, to fall by 0.3, that's a 30% reduction in growth. And we're expecting to also lose about 30,000 jobs at the very least from those tariffs. So once again, whereas the rest of Africa managed to negotiate lower tariffs, we have not managed to negotiate anything. So things are looking up, that are taking a long time, and we don't expect there to be anything happening anytime soon, but we are overweight South Africa just because we are overweight emerging market bonds. So we're overweight South African bonds, we're overweight emerging market equities, and we're overweight South African equities. So that's despite what is going on in that time.
A good picture. And it's, I think so. I think so. They're very enthusiastic in a lot of ways. It's been a terrible war, should have ended. And Russia should have stopped it. But they've been 3.5 years and they've gotten not so far. So we'll see what happens. But the other side can fight too. And they've proven that. Maybe it's it could be that Russia is a paper tiger.
Is Russia a paper tiger? Is this all a lot of hot air? Not sure. They certainly are playing with fire when it comes to what we've seen over the last month. So the oil price spiked this month when Trump reversed his stance on Russia and Ukraine, now blaming Russia and saying that Russia needs to fix things as opposed to what he was saying earlier, which was that the Ukraine needs to just accept defeat so that the world can move on. Now, that's quite important because one of the reasons that the tariffs in the US haven't led to much inflation is that the oil price has fallen quite dramatically over the last 6 and 12 months. And the lower oil price has helped to counter the rising tariff inflation. Businesses are spending less on oil. They can absorb those savings from oil, so they don't have to pass on tariff inflation pressures to the consumer. Consumer stays in a net zero position. But if we start to see the oil price tick up, that buffer goes away, that buffer reverses, and suddenly you've got tariff pressures rising and the oil price rising. So we'll be watching this quite closely, and things look like they are heating up. We had Poland shooting down 19 Russian drones that entered their airspace, causing PM Donald Tusk to invoke NATO's Article 4 to consult allies on collective defense measures. We also had the Lithuanian president warn Russia of the recent entry of 3 armed Russian fighters into Estonian airspace. So definitely we're seeing a bit more happening in Eastern Europe and Russia. And if that does lead to higher energy prices, well, that could be a catalyst that unwinds what we're seeing in terms of pressure on the dollar. The dollar would start to strengthen, and the Fed might have to start to raise rates to counter that inflation, and then we could see everything else coming off, including gold, despite the fact that geopolitical risks would be rising at exactly that time. But right now, gold is pricing in more of the debasement trade and the Fed uncertainty than there are geopolitical risks. So you could have the exact opposite thing happening. As risks are rising, gold could be falling. It's not just war that is a concern. And yes, we did see Israel launch an unprecedented attack on Qatar. But at the same time, we also seen Trump's potential solution to the war in Gaza. So that's more of a neutral outlook. But politically, a lot of other things are happening as well. Japan, we saw a prime minister resign there after their party's election loss. And as I've mentioned, in France, we had the new PM resign after 26 days in office. So definitely another Lettuce Liz UK repeat, and again just on the back of debt. And again, that debt is, while it's above the 3% target for the EU, sitting at 5.7%, nowhere near what the US is doing and nowhere near what China is doing. So, it is a concern that if such low levels of debt can result in governments being toppled in the UK and France, well, what's going to happen in the US? How long is the shutdown going to last? How much further can US debt levels rise before something has to change? Where's the best place to hide? And it looks like gold has been the best place to hide for now. But we prefer South African equities or emerging market equities than gold. Perfect. So how does that bring back us to our overall position? As I said, we aren't fighting the Fed. We remain overweight equities and we remain overweight emerging market bonds. We remain underweight developed market bonds, which are more of a defensive position, something you'd see if you're moving into a recession. We can't see a recession coming anytime soon. Not only is monetary policy relatively loose, around the world, but fiscal policy is just way too loose. As I said, 3% is what you should be if your economy is slowing down. The economies aren't even that slow, and we've got 9% in the US, debt to GDP, fiscal spend. We've got China at 12% fiscal spend for the year. That's not their total debt to GDP, that's just how much they're spending each year. So a lot of support from governments right now, relatively easy monetary policy. The chart on the right shows that overall financial conditions are relatively easy as well. That's in the US. So when you've got easy financial conditions, when you've got interest rates that are being lowered, and you've got huge government support, it's very difficult to see a recession coming. And that's why we aren't fighting the Fed, and we are overweight risk assets. But things are looking quite worrying. Not only is the gold price very stretched to fundamentals in emerging markets, we've seen huge speculative positions, but we've still got the fact that inflation is likely to hit the US. The reason that growth has been higher than expected year to date is because we've had this rather staggered implementation of tariffs. So it was all supposed to be on implementation day, on Liberation Day in April, and Trump has been kicking the can down the road, and we had little bits trickling in, so that by July, we only had 9.7% effective tariffs. That's expected to rise on current tariffs, and Trump every day brings up new tariffs on pharmaceuticals and other sectors, but just on current announced tariffs, that's going to rise to 19% by the end of the year. So that's a doubling of tariffs. Plus, because companies are relatively robust and the consumers are relatively robust, companies are expected to pass on more of that tariff, which means that it's not just a doubling, it could be up to 6 times the impact that's felt on inflation. And so inflation is likely to feed through into the US. Now, US companies are currently countering that by not hiring and spending massively on infrastructure to try and improve their productivity. So AI is something that's being used heavily. They're automating, trying to reduce staff costs because of the tariffs, trying to reduce overall costs to counter the increased tariff inflation. And that has led to a weakening in hiring. Fortunately, the labor supply side is also weak. So overall, the US remains relatively neutral. But if we see this huge inflation come through as there's a hiring freeze, or that could lead to a slowdown in the US, further slowdown, and would have high inflation at exactly that point. So it would be a stagflation storm for the Fed, high inflation, falling employment, and that could be something that markets react quite poorly to. But for now, markets aren't worried about that. For now, bad news is good news. And every time there's a weak number out of the US, weak growth, weak employment, well, that's just fuel for further Fed rate cuts. And that just means that the market continues to rally, the dollar continues to weaken, and gold continues to go up, and emerging markets continue to rally. And the current Goldilocks, literally, that we're going through is likely to continue. But as I said, not only is liquidity conditions easy, but Atlanta Fed's GDP now forecasts growth in the US for this quarter at 3.3%. So growth is robust. When the growth is that robust, it's going to be very difficult for inflation not to start to feed through, and then it'll all be down to the Fed. So, I'm quite confident that we will see inflation come through towards the end of the year. The big question is, what will the Fed do about it? If they start to behave rationally and raise the dot plots, or reduce the number of cuts that's going to happen going forward, well, then the dollar will strengthen, equity markets could collapse, gold could collapse, and we've got to have a general risk off, except for US bonds and the dollar, but more generally just the dollar would rally. But if the Fed decides that political pressure is more important, and they keep cutting rates despite what's all this inflation that's coming through, well, then gold will continue to rally, as will emerging markets. So it's difficult to see exactly how the Fed is going to react. So for now, we're just keeping our positioning because it's working, and because we can't see a catalyst for anything to change until that inflation feeds through. Once inflation feeds through, well, then we'll probably change our view. But fortunately, we've been waiting for that catalyst. We haven't banked our profits early. because if we had, we might have banked 4 months ago instead of holding on to those positions, just because things are looking quite stretched. But we continue to wait for that catalyst before we do anything. But as I said, we have tightened stop losses because things are looking quite scary out there, just from a valuation perspective. But valuation is never a catalyst. Valuation is just a measure of where the market is. And so we await our catalyst before we do anything in terms of changing our positioning. One small thing we did is we did trim a bit of SA equities. We still have weight and moved into emerging markets. But that was more just a housekeeping position, nothing too large in the overall scheme of things. Our model stayed the same. Okay, so that's where we are. No change to our views since I last spoke to you. No change to what's really happening in the markets, with just a continued rally and increased geopolitical uncertainty. So we'll see what happens in October. But let's move to questions. Okay, Jacobus, is the current high SA top 40 purely a result of high commodities, gold and platinum? Jacobus, that's a fantastic question. So it is not just purely about the rally in SA. Well, it's not just purely about the rally in gold and platinum prices, which have driven SA platinum companies and SA platinum gold companies to 27% of our top 40. It's also because of the changes that the JSE did to our index. So there was something called index harmonization that happened about a year ago, where the JSE applied. So we used to have two indices, the SWIX, which saw a down weighting of the dual listed companies, and the all share. And about a year ago, the JSE harmonized those two and converted the all share to the SWIX methodology. They downweighted Anglos and Billiton and other dual listed companies, Richmond, British American Tobacco, and Anheuser-Busch, all got downweighted. And then they merged the two indices under the name of the all share. So currently we have the SWIX methodology under the all share, and that downweighting of those dual listed companies meant that SA focus companies got a broader exposure. And that's one of the reasons why gold and platinum are 27% compared to their previous peak, which was in 2008, whereas precious metals in 2008 were only 10% of our index. Anglos and Billiton was close to 30%. Gold and platinum around 10%. We had resources of 40% at the time. Right now, it's not as a result of Anglos and Billiton because they've been downweighted. It's because of gold and platinum. But at the same time, Anglos and Billiton haven't actually run that hard this year. So it's not just about the reduction in the dual weighting, but the copper price is up 6% compared to platinum, which is up 60%, and gold, which is up 50%. So it's the non-precious metals also haven't rallied very hard. So it's a combination of specific rallying in gold and platinum and the dual listing reductions that we see in our SWIX methodology. Faisal says, what's your opinion on rate property funds? Will they still go up to the end of the year? Faisal, that's a great question. So 2 points. One is that we continue to not have South African property as an asset class in our strategic asset allocation. Why? Well, because for one, it's part of the all share. It only makes up 5% of the all share. If we had to do a principal component analysis and break up the South African stock market into various pieces, i.e., if there was a reason to pull out that 5% of SA property from the all share, we would actually end up breaking our market into three: resources, which have a very specific driver, being commodity prices; industrials, which have two drivers, one being SA income, one being the rand; and then the third one, financials, which would include property shares, rates, banks, insurers, and retailers. They're all very much interest rate sensitive, and they would behave in a particular way. So, if we had to, we wouldn't just pull out property; we'd pull out banks and all financials at the same time. That said, we do have, although property is not in our strategic asset allocation, we do have a slight overweight to SA property, which means that beyond holding SA equities, we have a small allocation to SA property in addition. So we've got property in the all share and property outside of the all share because it's cheap. We're not excited about the fundamentals. We still think there's a demand-supply imbalance. We still think that with municipalities being bankrupt, they're going to raise rates, just like Cape Town's seen its 20% rate increases, and those rates get passed on to landlords, and that's not good for property companies. So we think that there isn't going to be a fast recovery in the real increase in dividends for property stocks, which is why we're not that excited. But because they are cheap, sitting at about 15% discount to NAV, well, we do hold a little bit of property, but very small. Louise says, surely healthcare stocks will bounce back at some point, regardless of Trump's policies. Aging populations are a reality. Louise, I 100% agree with you. And they actually did bounce back in October. So we'll see at the end of this month, we'll see some good numbers. But healthcare is now the best performing sector month to date in October because of the deal that Trump made with Pfizer and basically the whole sector as a result of that deal being more lenient than was expected. The whole healthcare sector has rallied in the short term. And we've also seen Berkshire Hathaway buying into the largest US listed healthcare stock. So together with Trump being more lenient on the health stocks and Buffett buying or Berkshire Hathaway buying, property is up, apologies, healthcare is up 5% in dollars month to date. And this could be the catalyst to see healthcare run further because it's certainly at a huge discount to its historic valuation. And it definitely structurally, aging populations benefit that sector more than anyone else. So we haven't gone overweight the healthcare sector yet. We're still waiting to see some recovery in the earnings revisions. But yeah, the two catalysts we saw, I think, that's led to a bounce this month, and it could be the beginning of a nice rally in healthcare stocks. So we're just holding back a bit, and there's a lot of scope for it to rally. So we're not worried about missing out on too much, but we'll wait to see if that bounce solidifies into something a bit more substantial. But right now, Trump's policies have actually led to a bounce in October. Daniel says, do you think the absence of data for the Fed to base its interest rate decision in October will force them to hold rates steady in the short term, at least until the government shutdown is over? So Daniel, that's another fantastic question. So there is still some data. There is some private data that comes out. So the Fed won't be completely blind, but they'll probably have about half as much information as they would normally have. Now, I think it all depends on what Trump does. He's out there threatening to do mass firings. If he goes ahead with mass firings, the Fed might be forced to protect employment to cut regardless of what the data is saying, just because they're worried about the impact of mass firings. If the Fed, if Trump doesn't fire anybody, well, then I think there's a good chance the Fed will not cut. There are others who say that the Fed would have to err on the side of caution, and because the Fed has less data, that they should cut just as another risk management cut because, well, they are half blind, and so rather be safe than sorry. But at the same time, we're seeing a lot of Fed speak come out, and a lot of the Federal Reserve Bank governors, the 12 members of the FOMC, a lot of them have been out quite aggressively since the FOMC, saying that given where inflation is, rates should stay steady. So, that might buckle when it comes to the actual October meeting, and they might bow to political pressure. But right now, judging by Fed speak, looking at the data, I would say that assuming Trump doesn't do mass firings, the Fed should stay and not cut in October. But it's very difficult to forecast. Certainly, the market is forecasting a cut. I think there's a 90% probability of a cut. So if you have to go by the market, if you want to go with consensus, then there will be a cut in October, despite a shutdown. Thanks, John. John says the health fund seems to be lagging all indices. That is correct. What is our positioning on the fund? When do we expect to see a reversal in this trend? Do we know current PE of the fund? So John, you're spot on. Just as I said earlier, I can't give you the exact PE number, but on a PE ratio relative to other sectors, the healthcare sector is the cheapest it's been in probably a decade. So the healthcare sector is certainly very cheap right now. It has performed terribly. So one of the reasons it's so cheap is because it's performing so badly. The earnings haven't really recovered. We haven't seen the recovery that we were expecting to see, and part of that is very much specific. We had much lower than expected earnings come out of Eli Lilly and Novo Nordisk on the back of their weight loss drugs disappointing. We also had the huge scandal at Universal Health, which also led to poor earnings there. And we had a new CEO who, what new CEOs do, they throw out the kitchen sink and they tank everything so that under their new leadership, earnings can recover. So there hasn't been decent earnings. So the price has fallen, and there's been a derating as earnings have fallen, and the price has fallen even faster than earnings. I do think we are very close to bottom. Trump is the one catalyst. Berkshire Hathaway buying is another catalyst, but we haven't seen a recovery in the earnings yet. So we're waiting for recovery in those earnings. I can't tell you exactly when that's going to happen. Maybe it's 3 months, maybe it's 6 months. But I suppose couldn't hurt to start nibbling now, just because it is so cheap if you have a long-term view. Johan says, do you think gold will be revalued, and what does the effect could be on market economies? Johan, I'm not sure what you mean by revalued, but at this point in time, gold is certainly looking stretched. And I think that if there's more credibility in the Fed, gold could fall quite aggressively, and that would certainly impact emerging markets, gold, South Africa in particular, based on our exposure to that in our market. Yeah, I mean Australia as well is also quite heavily exposed to gold. So they could also take a hit, and some other markets, South America as well. Yeah. Andre says, I want to invest in bonds, too much exposure to US shares. Which of the two Signia bond funds should I invest in, or should I split the investment between the two? Okay, Andre, it's a great question. So when it comes to our unit trusts, there's the Signia Enhanced Bond Unit Trust and the Signia All Bond Unit Trust. Both of them are duration neutral. So both of them follow the duration of the bond index. We don't take a view on whether the SARB is going to cut interest rates or raise interest rates. We don't go long the back end of the curve or short the short end of the curve or make any duration calls, because we think that it's quite difficult to do that consistently over time. The all bond index is passive and just invest straight into the index, which is mostly government bonds. I think it's 97% government bonds. And there's about 3% SOEs, but they're government guaranteed. The enhanced bond fund, that has additional credit exposure as well. So I think there's some SANROL, which is government guaranteed. There's some Chancellor, which I think is also government guaranteed. There's also some other credit exposure, some bank exposure, some other SOEs exposure, which is not government guaranteed. But there's some credit, basically there's credit in that fund, which allows for that small pickup. So I think you're getting about an extra 0.5% a year right now in terms of credit pickup. Generally quite high rated credit. And that gives you a slightly higher return, just so that we can compete with active bond funds, which do have exposure to credit. So we've got active credit in the one fund, no credit in the other fund. Both are duration neutral and in line with the index. And I think they're both the same fee as well. So it just depends on whether you want additional credit exposure or not. Johan says, what will be the effect if peace between Russia and Ukraine happens? Sure. So I think nothing too much in the short term. I mean, you would think that the biggest beneficiary of peace would be an energy peace dividend, i.e. lower gas prices in Europe and lower oil prices. But the oil price is pretty low because OPEC has been increasing its supply more than expected quite aggressively. And even natural gas prices are pretty low because the storage levels are at record highs in Europe. So I think, and we also wouldn't see an end to sanctions. In fact, Europe's about to increase its level of sanctions. So possibly if there was peace, sanctions wouldn't increase, but I would say probably not much impact, at least in the short term. Whereas if there's no peace, we're probably going to see higher levels of sanctions, which could actually increase the oil price going forward. And certainly, you know, we had the threat recently from Trump on India and China about 100% tariffs, secondary tariffs on oil, all the oil that India and China imported from Russia. That's gone very quiet, but you know, something like that could definitely push up the global oil price and global inflation quite quickly. So it all really depends on sanctions more than in peace, even if there is some sort of peace process that we move towards. But the probability of peace over a 1 year period, I think, is down to 40%. So nothing too exciting happening there from a peace perspective. Louise says, you indicated things are not looking rosy for SA bonds. Okay, Louise, that's a good question. So we are overweight South African bonds because we're overweight emerging market bonds. And yes, South African bonds do have very good real yields. I think we're the third highest in the world. Brazil is first, Comoros second, and then we're third in terms of real bond yields. So yes, we're positive emerging markets, and yes, South African bond yields are quite high relative to the rest of the world. And yes, we should have a decent budget this month. In fact, actually, you know, next month we'll be able to look more deeply into the budget, and that's something, it's a risk that's coming up in the next 2 weeks. We should have a relatively decent budget because of the tailwinds from high commodity prices. So all those gold companies and platinum companies should be earning super profits, which should lead to super taxes, corporate taxes, which at least help our budget deficit be balanced. But the longer term story within South African bonds remains our growth is not there, and we've got some expenses that we didn't include in our budget last time. So you know, we've got the social grants, which they were only budgeted for 1 year. Those could be extended next year in February. And we've got growth, which is very low. So I think we might get away with no negative news in October, just because of the fact that we don't have to announce what we're doing for social grants, and we've got record corporate taxes, hopefully. But by February next year, well, then we do need to have a solution to that spending. So I can't see our debt to GDP falling more than expected. I think it'll probably have a neutral budget at best. In October, with probably something a bit more ugly in February. So what I mean by things aren't looking rosy, I mean the fundamentals in South Africa are tough. South African fund managers have been selling bonds, but we've had record inflows from foreigners. So the only thing that's been supporting our bonds, and our bond yields are actually looking pretty expensive, is the fact that foreigners have returned to South Africa, despite the fact that we're junk. So it's just because we're an emerging market. Foreigners are loving emerging market local currency bonds. We're overweighted to ourselves. And so the foreign flows are driving our bond yields, just like they're driving gold and our equities. And so, yes, the momentum is positive for SA bonds. That's why we're overweighted. But the actual fundamentals are not looking great and are deteriorating. And we could see, if the foreigners had to stop buying, or we could see things turn quite quickly from our bond perspective. But for now, I suppose the momentum is there from a price perspective, even if the fundamentals aren't. Thank you, Karina. Gavin asked for a comment on Bitcoin. So Gavin, two interesting points. One, and this is from JP Morgan, they have a volatility adjusted price for Bitcoin. They say Bitcoin is digital gold. Yes, it's more volatile than gold. So if you adjust for volatility, where should Bitcoin be? And they say on a volatility adjusted basis, Bitcoin should be at $160,000 right now, which is equivalent to $4,000 an ounce of gold. So relative to gold, Bitcoin's actually quite cheap. However, both of them have done incredibly well over the last 12 months because of the debasement trade, because the US has so much debt, because the Fed's credibility is waning. And yes, so that could continue. That's why we remain with our position. But if that had to change, if the credibility of the Fed had to improve, well, then you could see quite a dramatic reversal in the debasement trade. So gold could come off. And if gold comes off, well, then Bitcoin is likely to come off as well. Probably not as much, because it didn't go up as much, but I think that they are linked in that alternative dollar space for the debasement trade. Josh says, do you see near-term recovery in health stocks, in particular the Signet Itrix Health Innovation actively managed ETF? I hope you heard what I said to the previous questions, but we're not getting involved just yet. We're waiting for a more concrete change in earnings revisions. But yes, we've already seen 2 positive catalysts. So things are bottoming, and the short-term prices has bounced quite nicely. So we might be very close to a bottom. And we're watching that very, very closely. Pierre says, given Rand's strength, is not a good time to increase offshore exposure into value stocks. Pierre, again, you're spot on. It's one of the great luxuries that we have in terms of managing balance funds, is that we have access to FX hedges. So your problem is, when you want to buy global equities, they tend to be very expensive because that's when the rand is strong. And when the global equities are cheap, well, that's when the rand is weak. So it's nice to be able to, when global equities are cheap, to get that exposure, hedge the weak currency, and then when the currency strengthens, we unwind the hedge. So it's nice to have both those tools when it comes to investing offshore. Right now, the rand is looking relatively strong. Certainly, as I think I said in last month's, or maybe in the previous month's webinar, the rand could be as low as 15 if you had to go purely on our terms of trade with commodity prices. But the last time that happened, our growth is very strong, and we still have a lot of impediments to our growth, a lot of productivity issues. So I don't think the rand's going to get that strong. But I think even though the rand is probably fairly priced, it's interesting that if you look back over 10 years, the rand is only weakened by 3% per annum, whereas the historical, if you look at 20 and 30 years, the rand weakens at about 5% per annum. So the rand is actually, at least on a 10-year view, quite strong. And so I don't think now's a bad time to taking money offshore if there's a sector that you want to get exposure to. Of course, everything's also looking quite expensive, particularly US equities on a Cape perspective, but yeah, I think right now it's not a bad time to be taking money offshore. Certainly, we have been increasing our offshore, even though we've been increasing our offshore to emerging markets, not to developed markets. Anonymous says, refreshing to see that the Signet is offering access to Bitcoin via your ETF. It's anonymous. It's not an ETF. It's via our linked life license. Do your marketing efforts refer to Bitcoin directly, or what is no? Sorry, digital gold is just me. The marketing sheet on our website and the fact sheet on our website, we call it Bitcoin. That's what it is. Bitcoin is exactly what the exposure you get to, and that's what we refer to it as. It is the Signet Life Bitcoin Plus Fund. So I just call it digital gold because I've been talking about gold right now. So it's cryptocurrencies are a form of alternative gold, and that they're a debasement trade that's not physical but digital. So maybe I should call it, I'm not sure. The digital debasement trade as opposed to physical debasement trade. But no, our marketing sheet refers to it as the Bitcoin fund. We don't have an ETF yet. We're still waiting on the JSE. That always takes longer than we'd like. But as soon as we're allowed to offer an ETF, which invests in the iShares ETF through a feeder fund, we will definitely do that. Mandy says, a question about Fang.ai and fourth industrial revolution ETFs. Would you consider to replace Broadcom with AMD in that portfolio due to the fact that AMD are getting more contracts with big tech companies at the moment? Mandy, that's a fascinating question, and it's something that we are looking at very closely right now, because the amount of M&A, mergers and acquisitions that's happening in the AI space is just staggering. And I mean, literally staggering. I'm almost more bowled over by what's happening in the AI space than I am by the gold price. Every day, OpenAI announces a new contract where they're spending hundreds of billions of dollars on chips, future spend on semiconductors. They have the deal with NVIDIA. They have a deal with yesterday with AMD, and we saw the AMD share price rally 30%. There's the deal with Oracle. So OpenAI must be cumulatively spending over $1 trillion over the next 5 to 10 years on chips, but they don't have any cash in their balance sheets. So So we don't understand where that money's coming from. Yes, that company's just been revalued at 500 billion. So I think it's one of the biggest startup companies ever, and has overtaken SpaceX in terms of valuation. But it's still a non-profit company, and it still doesn't have any cash. So how it plans on spending that $1 billion, I'm not quite sure. So we've seen Oracle rally 40%, AMD rally 40%, all on the back of these huge future revenues that have been guaranteed in deals with OpenAI. And we're just not quite sure where that money is going to come from. So we're a little bit worried that just like emerging markets are stretched because of the huge position by huge speculative positions, and gold is stretched relative to its valuation. We're just worried that M&A prospects are stretching US tech quite a bit. I mean, this reminds me very much of 1999, when you had highly priced companies issuing paper to buy revenue streams that weren't even online yet, hoping that they paying for clicks back then. Right now, it's paying for AI training on semiconductors in data warehouses that don't even exist. So with OpenAI is using money it doesn't have to spend for the next decade of construction of massive warehouses that are going to use huge amounts of power to invest in thousands and hundreds of billions of dollars of chips to train future models. I mean, we really are starting to look at a point like the future of the Matrix. You go out to the surface of the world, and there's just these data warehouses everywhere with these huge server farms backtesting things. What data they're going to backtest on, I don't know, and what these models are going to do, I don't know, and how they're going to turn that training into money, I don't know. So yeah, we're getting a bit worried about the overall FANG space. We don't have exposure to the FANG fund in our portfolios. We do have exposure to both AMD and Broadcom in the Fourth Industrial Fund, only Broadcom in the FANG fund because it's in the FANG index. AMD is not in the FANG index. Post the 40% rally yesterday, I'm not quite sure what's going to happen. Even these deals, NVIDIA made 5 times the amount of money in their purchase of Intel through Intel's share price rising on the deal. Likewise, OpenAI has made paper profits on their investment into AMD, which went up 3 times based on the price that they bought it at. So it's this almost like a Ponzi scheme where you're creating profits through paper profits through deals which don't have any revenue. It's all looking rather complicated and incestuous and tricky. So we're a little bit concerned about that space, just like we are gold and emerging markets, but we're holding on to SA equities and holding on to emerging markets. Manny says, sorry, another question. Do you have an exposure in the AI industry and nuclear power, or any energy for supply or energy for data centers? And if so, which funds? Sure, Manny, that's a good question. I'm not actually sure to what extent there must be some nuclear power exposure in the NASDAQ, which is basically our tech Fourth Industrial Revolution Fund, which is very similar to the NASDAQ. Certainly within the Signia OSE fund, for those of you who hold that, and that's had very nice performance lately on the IonQ quantum deal. There's quite a large exposure to First Light Fusion, which is fusion power. So if you want exposure to future power, there's fusion there. In terms of nuclear, no, I can't give the exact number, but we've also seen a reversal of the greenification of energy demand, with a lot more power happening not only to nuclear but to coal and other dirty industries. So it's not just nuclear power that's benefiting from these, but you're spot on. I mean, the amount of power that needs to drive these data warehouses is huge, and the global property sector now has actually got quite a strong underpin because of the huge demand for data warehouses. You speak to any engineer in Australia, and they're not working on fancy bridges or airports or sewer systems. They're all building warehouses. Super boring for an engineer, but that's the demand right now. There's just data warehouses going up everywhere for server farms and power deals as well. So Andy, it's a great question. I don't think we have any specific exposure, but there must be some. that's there. Albert says, do you foresee that the MSCI World Index will slow down significantly? Albert, as I said, we're overweight equities because the momentum is so strong and we can't see a catalyst for that to change. But from a CAPE perspective, which is, the best fundamental view, but it only works on a 10-year view. Remember, we had Goldman Sachs come out in October last year. So a year ago, Goldman Sachs came out to say that based on the CAPE, the 10-year PE, US equities were so expensive that over the next 10 years, you'd be likely to get 3% per annum from US equities. And that was before even Trump's policies on tariffs, which led to this huge disarray on the consumer and uncertainty and reduced spending. And US equities are up 16% in dollars. So, that's basically 5 years worth of returns if you have to look at Goldman Sachs' forecast, all in 9 months. So if you had to forward track that CAPE from last year, it's even more expensive. And, the likely 10-year return from US equities is probably, or global equities is probably down to even lower. But, if you had followed the CAPE in October last year, you would have missed out on this huge rally that we've had this year. So we can't use the CAPE as a catalyst. But certainly, if you are lucky enough to have a 10-year view, right now, the CAPE indicator, a 10-year PE indicator would say equities are very expensive and you'd rather hold bonds. CAPE doesn't work on gold because gold doesn't have an E. There's no earnings or no dividends. But if you assume it's going to, at some point in the future, revert back to the cost of mining, well then, that's a 50% reduction in the current price. You could say the same about Bitcoin, but Bitcoin is also, I haven't seen the latest cost of Bitcoin mining. I think it's around $40,000 compared to $123,000 the price, but I'm not sure. Mandy says, do you have any views around CBDs? Sorry, Mandy, what do you mean by CBDs? CBD, I mean central bank digital currencies, and where are SA standing as? So Mandy, that's an interesting question. So, when it comes to central bank digital currencies, so now, we're talking about, I don't really see the point of them. I mean, the whole point of Bitcoin is it's decentralized. So if you suddenly have a centralized digital currency, well, it kind of defeats the whole point of distributed ledger, which drove cryptocurrencies. Not only that, but most of the digital currencies that are being put forward right now, you don't earn any interest on stable coins, for example. So you'd rather actually hold physical. Well, I mean, physical. We hold dollars in our funds. It's not physical, but it's digital, but it's not digital. It's physical somewhere in a vault somewhere. So yeah, I don't really see the big driver for digital currencies. I mean, the main, if you had to look at what's driving stable coins, for example, so like the dollar stable coin, which is the dollar digital currency, it is crypto users who are wanting to hedge their exposure. So they think that Bitcoin's run enough, or Ethereum, whatever NFT is run hard enough, so they switch that into the stable coin for a while. So it's more of a parking place for crypto holders. The direct exposure in stable coins or digital currencies is not really there yet in terms of demand. Maybe that it all changes. Certainly the US is trying to push it because stable coins is dollar stable coins is the biggest stable coin. So that would help drive money into the US economy. And as a result, every other central bank is trying to create their own digital currency to try and keep money in their own currencies as opposed to letting it all go into dollars. So there is this race to try and get money away from the US. But yeah, I don't really see the point, to be quite honest, unless it becomes far more easier to transact it. If it becomes more easy to transact it, well, that changes the whole banking payment system. And then you've got to worry about PayPal, Visa, MasterCard, and all the traditional banking systems. But that is not so much a store of value, but it's a transactional system. But we're certainly nowhere near people using stable coins as a payment system anytime soon. Thanks, Mandy. I'll go have a look at that. And that's it. That is the last question of the day. So Once again, thank you very much for joining. Thanks very much for your time. Thanks for all the questions. I really enjoy answering them. All the best for October. Let's see if it's another positive month. Certainly the momentum seems to be strong, but we've got the next Fed meeting this month, and it all depends on what the Fed does. If the Fed suddenly turns hawkish, or we could have some big swings. But if the Fed stays dovish and listens to Trump, well then the sky's the limit for gold and Bitcoin and equities and anything else that emerging markets, anything else that relies on an alternative to the debasement trade. So have a great month.